Hello friends, welcome to our channel Cards and Loan Official, and today we are going to speak about personal loan, and it's an important subject because one of my viewer, he has requested for personal loan and he wanted to understand the concept of personal loan. So what we'll do is we will talk about personal loan from sales perspective or from a consumer's perspective. But before we proceed with the product personal loan, what we'll do is we'll do a little bit of scribbling while I explain you the product. But before we proceed with the product, or when you are watching the whole video about the personal loan, there are a few questions that I'll be asking, and I want you all to answer those questions. So the first question that I should be asking is, so let's proceed with what personal loan is. So first is personal loan. We are going to talk about personal loan today. It's an important subject, and when we talk about personal loan, we will talk about personal loan from sales perspective or from consumer perspective. We are not going to talk about personal loan from like a chapter in a book. Okay. So before we proceed with personal loan, can you tell me the reasons why an individual or why a customer or a consumer needs a personal loan? What are the reasons for them to need a personal loan? That is something which I'm not going to explain it here right now. I want you all to answer in the comment section on why we need a personal loan. So let's understand the definition of a personal loan. Personal loan is for example, it's money, it's cash. Okay, personal loan is cash or money. Cash or money, it doesn't mean a hardcore money. The banker or the person, this banking salesperson, he doesn't come up to the customer's place with a suitcase full of cash saying that, yeah, here you go, this is your personal loan and you can have it. It's not the cash in a literal meaning, all right, but it means something which is credited to savings slash current account. All right, so it's a money that gets credited to an account. So what is personal loan? Personal loan is money or a cash which is credited into a bank account, provided few criteria are met. Number one criteria is on an agreed rate of interest. So what is the first criteria whom we can give a personal loan? We can give a personal loan to a person. Number one would be eligible. He needs to be eligible for personal loan. Now let's say when we talk about eligibility of a person, any person who has money, okay, and he steps into, I'm just trying to give you an example, and he steps into a grocery shop or into a supermarket or probably a store of apparels, right, a garment shop. So when he enters into that, he has the money and he can afford that particular product, then he can go and buy that particular product. But when it comes to a banking product, whether it's credit card or it's personal loan or mortgage loan, auto loan, any product, for that a person needs to be eligible, right? So before we understand how he can be eligible, let's try to understand what are the customers who are not eligible. Okay, so when we are talking in a perspective of banking parameters in this part of the world, which is UAE or Dubai. So we need to understand the customer who are non-eligible, then we will get to know the customer who are eligible. So let's understand the customers who are non-eligible. Okay, so number one, who are the customers who can be non-eligible? If you will see, the customer who are non-eligible is, number one is people who have check returns or DDA returns. Check returns is he has issued a check to someone and that was not honored in the bank and it got returned because of insufficient balance. So number one, who's check returns in last 3 months or DDA return. What is DDA return? Generally, when we talk about DDA return, it can be last 3 months or last 6 months, like, depending on different banks, they have different ways of analyzing our customers. So check return or DDA return. DDA return is like, it stands for direct debit authority. And let's say if a customer has taken any product from anyone, like, he has taken an auto loan, or he has taken a mortgage, or he has given an authorization to a bank saying that, okay, you can debit my account on certain date every month. So DDA or check return are similarly same, and if this returns like, within either 3 months or 6 months, then he becomes non-eligible. That is number one. Number two, if a person has DPDs. Now, what does DPD stands for? DPD stands for days past due. If a person has DPD, like, in current month, then probably we cannot go ahead and give him a credit facility, because in that scenario, it becomes important for us that he should not have any DPD in the current month, right? No DPDs. It should be zero. He should be a good boy customer. Third is, he should not have anything as an arrangement. Okay, what is arrangement generally? Arrangement is nothing but, when you check the ECB report is nothing but Al Ittihad Credit Bureau, and you can go to my previous videos where I have explained about Al Ittihad Credit Bureau. If you want me to explain you in a better way, I can do that. Similarly, the way I'm writing right now, I can explain you in this fashion also. But let's talk about arrangement. So arrangement is like, a customer, he has an intention to pay to the bank, but he does not have the ability to pay to the bank. So if he doesn't have an ability to pay to the bank, but he has an intention, so what he does is, instead of, let's say, if he has taken a loan for probably 3 years or 4 years, so he wants to pay it in 5 years or 6 years, he's saying that, fine, like, I cannot pay within limited span of time, I need to pay it within an extended time frame, but I have an intention of paying it back to the bank. So that becomes a kind of arrangement. Okay. Or number 4, it's not probably delinquent. It's not a delinquent customer. Now, what do you understand by delinquent customer? Generally, when we talk about delinquent customer, it's like a person, probably he has an intention, he doesn't have an intention, but he does not want to pay the bank, like, whatever EMI that he's supposed to pay, or whatever credit facility that he has availed from the bank, he doesn't want to pay. So if he does not want to pay, in that situation, it becomes a delinquent customer. But there is a difference between delinquent customer and write-off customer. So what is write-off? When you talk about write-off, write-off means, delinquent means that customer is not paying, but bank has not closed its book. It has not considered that amount as a loss to his P&L. P&L stands for profit and loss statement. So he has not captured that as a loss. He has not captured that as a bad debt. He knows that he will be getting it today or tomorrow. He will surely get it. So he is delinquent. The customer is delinquent, but he will pay. He may pay. So if a customer is delinquent, like, different banks have different policies on when they can give the personal loans or credit cards or any other product. So if he's a delinquent customer, probably he will not get the credit facility. Now it depends on the time frame, probably whether his delinquent means he has DPDs, and DPDs for how many days, whether it's 6 days, 30 days, 60, 90, 120, 150, 180, it can go up to 6 months, and then it becomes a delinquent customer. Write-off is a scenario where the bank has taken into consideration that it has become a loss for me. Bank is not going to get any money back from this particular customer. Okay, so he puts it in a write-off book. So these are few reasons why a customer becomes a non-eligible customer. Correct? So if a person, whether he has money or he doesn't have money, whether he has a good salary or he doesn't have a good salary, or whether a customer has the financial muscles or he doesn't have a financial muscle, but if he falls into any of these criteria, probably we will, or the bank will not give him a credit facility, especially a personal loan, right? So we understood the non-eligible customers. Now the moment we understand non-eligible customers, we can understand the eligible customers. Now it becomes very easy because we can filter it, like, segregation, and then you step in. Now let's talk about the eligible customers. So what is personal loan? Personal loan is cash which gets transferred to customers either current account or a savings account. Majority of the bank prefers current account and generally if it's a salary transfer account. So majority of the bank prefers a current account, but cash or money which is being credited to customers current account, all right, for an agreed rate of interest. There needs to be an agreement between, so the application form which a customer signs, that's nothing but that's an agreement where customer has agreed that whatever bank is requiring, whatever rate of interest that bank is asking for, he should go ahead and proceed with that rate of interest. Now let's understand with an example. I as a customer, I want to pay, for example, 8% interest. Bank is saying that he is going to charge 9%. If both of us doesn't come to an agreement where I stick to my 8% rate of interest and the bank sticks to its 9% rate of interest, in that scenario, a customer can never get the credit facility or bank will not get the credit facility. So it has to be an agreed rate of interest. Correct? Second is, it should be an agreed number of EMIs. Okay, so the number of EMI that needs to be accepted on, like let's say I want to go for 48 months, whereas probably because of the bank's policy parameters or probably the bank doesn't want to give it for more than 24 months to me. Or let's take another example. I want a personal loan for 60 months. And the bank says that they have a policy which has been, or a guidelines which has been set by the central bank or a Reserve Bank of India, for that particular country, or when we are talking in respect to UAE's market, then central bank decides a tenor, or you can say tenor also, right? So they have decided a tenor that as an individual you cannot go beyond 48%, and the customer is adamant, no, I want it for 60 months, then the deal cannot be closed. So it means that it should be an agreed number of EMIs or agreed tenor, the number of months or the EMIs that, or the duration that a customer wants it for. So if a customer wants it for 24 months, bank can give 24 months, the deal can be closed. Customer wants it for 6 months, 12 months, bank can give it for 6 months, 12 months, deal can be closed. Customer wants for 60 months, bank cannot give 60 months, deal cannot be closed, right? So it should be an agreed rate of interest, agreed number of EMIs or tenor, and so based on the rate of interest, of course, you can take out the number of, the value of EMI. Now this value of EMI which customer is going to calculate, it should be within the concept of, or within the DBR, right? So it should not be the amount, the value of amount, it should not go beyond the DBR. Now when we are trying to understand about DBR, what is generally DBR? So few banks calls it DBR and few banks calls it DSR. Okay, it means both have the similar meaning, it's just that different banks are using different words, but it stands for debt burden ratio or debt service ratio. Alright, so it should be within the DBR. What can be the DBR? The value should be less than 50% of his income. So for example, here if customer salary is just let's try to understand, if customer salary is 7k, then DBR should not go beyond 3,500 AED, right? So if customer salary is 7,000, it should not go beyond 3,400 AED, correct? So what is personal loan? Personal loan is cash or money which can be credited to a customer's account on an agreed rate of interest, the rate of interest which is agreed by the customer and the banker, a bank, on an agreed number of EMIs or a tenor, how many months he wants to go, and the value of money that needs to be decided and should not go beyond DBR, like which is 50% of the DBR, right? And what else can be done? It can be that so I believe you have understood till here, right? Okay, so this is generally a definition of personal loan. Now, like generally, if you will see, it depends on the person's requirement. A person can have a huge requirement, a person can have a low requirement. So generally what happens is, in few scenarios, it cannot go beyond 20 multiples of salary. Okay, so 20 multiple is of course the extreme one, the huge, the the highest multiples of a salary. But generally what happens is, it should not be 20 multiples, it can be 20 multiples or lower than that. So customer can take from whatever amount, that is 15, 20, 25,000, 30,000, and it can go up to 20 multiples of the salary. Okay, this is what you have understood. Now when you talk about personal loan, there can be several personal loan. Now we have spoken about interest also, rate of interest. I'll explain you about the interest as well. But when you talk about personal loan, then personal loan, one is salary transfer loan and one is non-salary transfer loan, right? So we will tell you about salary transfer loan and non-salary transfer loan. I've just written it so that I don't forget. But third is what? Here, as based on the rules that has been sent or the governing that has been sent, here what is important is that customer should have a minimum salary requirement. Okay, so different bank, I'm not using any amount of salary, okay, because different bank have different salaries. Few banks can say that okay, we can go ahead and give a personal loan on certain amount of salary. Few banks can give a personal loan on a higher amount of salary. So whatever that bank has, on that certain amount of salary, so minimum salary requirement should also be there. And then customer has something, or a bank, what they looks into is that a person should be eligible based on ECB and their internal score. So whatever their ECB score is or whatever the internal score is, different bank have different policies, different bank have different benchmark or different calculation method. Based on whatever their salaries are, based on those eligibility, ECB or their internal scoring, whatever they have, they can decide of multiples of the customer and then they can give a personal loan to him. Now when you talk about salary transfer loan and non-salary transfer loans, salary transfer loans are something. So there are two types of salary transfer loans, personal loans here. One is salary transfer loan and non-salary transfer loan. So salary transfer loan is something where a salary needs to be transferred to the account, or from where the customer is going to get the salary. Because what happens is, here in salary transfer loan, the salary becomes the how do I say, salary becomes a security for a person's loan that he has availed. In non-salary transfer loan, remember here we have spoken about something called DDA. So let's say if a person has taken a non-salary transfer loan, then he issues a DDA, a consent form, that his EMIs will be deducted on so and so date from that particular account. And if DDA returns, it is not being honored, then a customer has to be liable to pay the penalty, plus he has to clear the DDA. If he does not clear it, then he can have the legal issues also. Okay, so this is how the whole pattern of personal loan is. Now when we spoke here about interest, there are several types of interest that we talk about. Interest generally are, if you see, number one is flat rate of interest. So what is generally flat rate of interest? When you talk about flat rate of interest, we all have, in our schooling, we all have done a simple rate of interest. When we do a simple rate of interest, the calculation is simple. Let's say if a customer is talking about 100,000 of loan, 10% interest on 100,000 becomes 10,000. So for 4 years it becomes 40,000. So 140,000 divided by 48, whatever the EMI is, that EMI becomes, the combination of both principal and interest. So flat rate of interest is the interest that bank charges, right? But generally majority of the bank, or I don't believe there is any bank who is charging flat rate of interest. Second is reducing balance method. Whenever you speak to a customer, you need to be very particular on what are the terminologies that you are using it, because the moment you say reducing balance rate of interest, so it means the rate of interest is getting reduced. But when we talk about reducing balance method, it means the balance that a customer has on the amount, there it's getting reduced. For example, I'll give you a hypothetical figure. It's a hypothetical figure, guys, because I'm not doing any calculation. I'm just saying, let's say a customer has taken a loan of 100,000. Okay, 100,000 for example, correct? Now on this 100,000 he's paying an EMI of 4,000, which has a combination of principal and interest. Principal is 2,000, interest is 2,000. In the second year, this 100,000, because the principal gets reduced from 100,000, the amount becomes 98,000, correct? Now the rate of interest, whatever the rate of interest is, that will be charged on 98,000. This becomes the outstanding amount on which the rate of interest we are going to charge, or the bank is going to charge. So in that scenario, reducing balance method is the balance, the outstanding amount of the customer is getting reduced month on month. So probably after, if you talk about let's say after 3 years, the interest that will be charged to a customer, it will not be on 100,000 or 98,000. It may probably come down to somewhere around 20 or 25k. Now again, guys, these are just a hypothetical figure. Please do not go on this. You can do the calculation on your own if you want to do it. But these are just for an example. I have given a hypothetical figure so that I can explain you the entire thing, right? So flat rate of interest, reducing balance method. Third is floating rate of interest. Okay, when you talk about floating rate of interest, then here the bank has margin, okay, that can be an interest, and in addition to that, they have something called IBOR. Like if you talk about LIBOR, which is London Interbank. So you talk about IBOR, okay, and then you talk about the margin that customer sees. So it becomes an addition. Generally, bank what they do is they take an IBOR plus margin for 3 months, 6 months, 12 months, okay, and then they proceed. It becomes difficult because IBOR changes every day, and they cannot take it for each day. So based on how the economy is performing, how the banks are performing, and how the global economy is performing, this IBOR may change on a regular basis, on a monthly basis, or a daily basis, or a weekly basis, right? So what they do is they put a straight IBOR of 3 months, that it may not go beyond certain months, and based on the IBOR rate, whatever it's fluctuating, the EMI can either become expensive or it can become inexpensive, right? IBOR stands for Emirates Interbank Offering Rate, okay. Probably I need to check again. Alright, but nevertheless, I think that's what it is. So this is how the rate of interest and salary transfer letter and non-salary transfer, salary transfer loan and non-salary transfer loan is being calculated. So in a nutshell, this is how the personal loan works, or this is how it works. If you have any questions related to this, you can please comment me in the comment section. If you need any answers related to something that I have missed out, probably I will try and I'll explain you in that. And apart from this, if you want me to write it and explain you any other subject which is related to banking or anything else, please do let me know, and we will ensure that we answer on that also. And I would like to take the name of the person who has requested me for this particular topic. Somebody called Dinesh, who has requested me that he wanted some information on personal loan, on how the calculation is being done and how we are doing other stuff. If you want me to show you the calculation on DBR, like how DBR is generally calculated in different banks, you can ask me that also, and I will ensure that I explain you in that in the next video itself. But please do ask me, and I would love to take the opportunity to thank Dinesh. Dinesh, thank you so much for raising a request that you want us to do a video on personal loan. I hope you like the video, Dinesh, and the other audiences also. So thank you so much, guys. Thanks a lot for your support. I would highly appreciate if you can ask me more questions and you can give me more topics on which I can explain you. If you liked the video, please do subscribe to the channel and please share it with majority of our friends. I hope that will really make a difference to all our colleagues and sales officers who are working out there and who are struggling with the knowledge. So whatever little knowledge that I can share with them, I would love to share it. Thank you so much. Have a lovely day. Love you all.